Hello there, my name is Aaron. I work for Investinable, and today I'm going to be taking you through an important concept in trading called liquidity sweeps. Today we'll be covering what they are, why they're significant, how to identify them in terms of bullish or bearish, and how traders use them in their strategies. So let's get started. So what is a liquidity sweep? In trading, liquidity refers to the availability of buy and sell orders at different price levels. A liquidity sweep occurs when the market moves aggressively to take out stops or orders that are clustered around certain price levels, such as support and resistance zones. Liquidity sweeps are often used to trade reversals, as this allows the market to hit certain levels and move significantly in the opposite direction. So why are liquidity sweeps so important? For one, they reveal the underlying intentions of the market's big players, such as institutions or large traders. These players often push prices into areas with concentrated liquidity to trigger a reaction before making their intended move. In some cases, liquidity sweeps are seen as manipulation in the market by larger players. However, if a trader's technicals are lined up correctly, they can use this manipulation in order to trade with the majority of the move. So now let's talk about how to identify liquidity sweeps on your charts. Here's the main things that you should look for. What we'd likely look for is key price levels to identify liquidity. These would be previous highs and lows, as well as support and resistance zones, or even psychological round numbers. Along with this, once we've plotted our levels on the chart, we will then look for aggressive moves that breach these key areas, which will often trigger stop losses or pending orders, causing a massive spike in price. Another way to identify when a liquidity sweep could occur is during certain time periods. These can be things like the New York Open, which will occur around 2:30 p.m. UK time. And during this, the US markets will open and cause certain indices and FX pairs to move quite erratic. Although it should be noted that these high volatility spikes in price aren't always guaranteed reversals, and you should always stick to your trading plan. To help you guys understand how liquidities would look on a chart, here we have charted them and pasted them onto the slide so you can see the difference between a buy-side liquidity sweep and a sell-side liquidity sweep. The way we have identified these is that the candle has wicked past the previous highs and lows, and the candle has closed inside the range and not breaking the structure. This clearly identifies that this was a liquidity sweep, and stop losses have been hit and potentially pending orders. Further on in the course, we do show how we trade these reversal patterns, but we will leave that for another video. Finally, we'll be covering how traders use liquidity sweeps in their strategies. To start with, once a liquidity sweep has occurred, some traders will look for entry points. A trader may enter a trade in the direction of the reversal, using the sweep as confirmation that the market is about to move strongly in the opposing direction. However, when doing your analysis and potentially entering, it should be understood that traps are potentially in the markets, and by understanding which way a sweep is and why it's moved that way can help you ensure you're not caught by a false breakout, which are common during any news events and levels being broken. As well as traders using this for entry points and identifying traps, it can also be used as targeting liquidity to take profits on original trades. The reason why a trader could use a liquidity sweep as a potential target for their take profit is because of potential pending orders or stop losses, which can cause them to hit TP, that being take profit, much quicker compared to a normal trade where there's no events and no liquidity sweeps. Overall, by incorporating or even being aware of liquidity sweeps in your analysis, it can make you more informed when trading and potentially increase your profitability if used correctly. In conclusion, liquidity sweeps are powerful market events that can signal significant price movements. By understanding what they are, knowing how to spot them, and learning how to trade them, you can avoid common pitfalls and position yourself to take advantage of the market's dynamics. Thank you for watching. I hope this presentation has provided you with a valuable insight into liquidity sweeps. If you have any questions, we'll be happy to answer them, and please get in touch if you have any other queries.